Thank you, Brian. And now for something completely different. Unlike Morris's presentation, this is focused initially on the upstream end of the equation, but we do have some downstream plans coming through in the not too distant future, we hope. Just to set the scene for this presentation and for this company generally, and no doubt for others in the presentation lineup tonight, Australia is running out of easy-to-get oil. We're currently importing 80% of our transport fuel requirements, which is a figure that not many people realise here today. Secondly, most Australian oil is sold at Tapas benchmark crude prices, which can be as high as 40% plus to West Texas Intermediate. Very recently, Tapas was trading at $111 a barrel versus West Texas Intermediate at $92 a barrel. Secondly, Port Darwin, which would be planned to be our major export port for anything that we produce in Central Australia, is only 7 days sail away from China. So this company, and obviously anybody else exporting out of Port Darwin, has a significant advantage in exporting to energy-hungry China, and secondly, India, where I think we're around about 10 days sail. Fourthly, based on historical information from known fields in Central Australia and our analysis of various transport, treatment, separation, logistics costs, we should be able to produce oil in Central Australia for around about $30 to $40 a barrel. As you can see from those Tapas benchmark prices, there's quite a significant bit of meat in the equation there. Another point to set the scene really is that DOM gas is going to be increasingly hard to get hold of in Australia. Morris spoke very eloquently of the boom in offshore exports of LNG. The Queensland Government and Santos have both forecast prices of $6 to $9 a gigajoule by 2015 in the eastern states. DOM gas for Perth already sells at about $9 a gigajoule plus for the Perth domestic market, and the federal government is going to enforce reservation of gas for DOM gas purposes, as is the West Australian government. Another point is that 120,000 petajoules of gas, that's 120 TCF of gas, is forecast to be production forecast, I should say, totally to 2030. So we are dealing, as far as gas is concerned and as far as oil is concerned, in booming markets which are not going to go away very easily. This company is a small company, and our biggest problem at the moment, we believe, is not being able to find commercial oil or gas or coal or other commodities that we hope to deal in. We wish to avoid being taken over, particularly at such an early stage in the company's life cycle. As you can see, our market cap today is actually a bit less than 70. It's around about $60 million, and we have 1.2 billion shares on issue. The other part of the equation here in setting the scene is the burgeoning influence of unconventional shale gas and shale oil developments in Australia. We've seen some very significant developments with Hess farming into Falcon's acreage in the Beetaloo Basin, ConocoPhillips farming into New State Energy, Mitsubishi farming into Baru's acreage. Armour Energy is setting up a float in the very near future, as is Tamboran Resources. They're all focused on unconventional, that is shale gas and shale oil. The value of these deals has varied considerably, and I believe we're at the very start of the shale gas and shale oil revolution in Australia. The first few deals were done at an average price range of $12 to $15 an acre, that is the net value per acre of the farm-in deal. Recently, however, that compares, of course, to the US, where new exploration acreage that, albeit may have demonstrated some prospectivity, is going for in excess of thousands of dollars an acre. The most recent deal done in the unconventional acreage seen in Australia of any significance has been BG and Drillsearch, BG farming in for an imputed value of $300 an acre. So there has been a considerable uptick in the value of unconventional acreage deals. We haven't done any unconventional acreage farm outs at this stage. We are in discussion with a number of companies, but we believe the time to do the farm out deal is when we're dealing with values in excess of, well, the green light has died. Anyway, in excess of $300 an acre. We'd like to get something closer to $500 or $1,000 an acre. As I said, we are in discussion with a number of players ranging from very large North American oil majors. I can probably use this one, can I, on the back? Sorry?
Just hold it for a second.
Okay, delayed reaction. Okay, thanks. Okay, moving on. The company does have an imminent 3-well drilling program, liquids-focused drilling program, kicking off by next weekend. We aim to re-enter Surprise, which we believe already may well be an oil discovery. We are focused initially on crude oil and condensate discovery and exploitation for early cash flow. Later, gas, helium and condensate discovery and exploitation for medium-term cash flow in the order of 3 to 5 years. And longer term, we have visions of getting involved into large-scale gas to GTL, that is petroleum liquids production, and or LNG for both domestic and export markets. And then finally, we do have probably one of the world's biggest tonnage targets of coal in the Paderca Basin, where we have between 300 to 500 billion tonnes of coal in an independently certified exploration target above 1,000 metres. We would like, as far as possible, to retain operatorship and majority equity in farm outs that we do. We do want to do more farm outs, but we're not going to do a farm out simply for the sake of saying we're heroes, we've done a farm out. We think it's much more fundamentally serious than that. We believe that the company is rather dramatically undervalued. We do have independent estimates of short-term valuations of 48 cents a share and longer-term fully diluted estimates of over $2 a share based upon longer-term projects that we aim to bring onto stream. We were probably the first company in Australia to publicly promote the idea of unconventional exploration. Myself and Greg Ambrose both released technical notes in 2007. We didn't have a lot of notice being taken of us then, but increasingly, as you can see, in Australia and around the world, unconventional acreage is being much more highly regarded than it used to be. I've talked about the coal. The fact that this area is highly prospective has been attested to independently with unconventional prospective recoverable resources of 5 billion barrels of oil and 42 TCF of gas at P50. Conventionally, in-house estimates around about 1.8 billion barrels of oil and 7 TCF of natural gas. We are leveraged to nearby unconventional activities such as Hess, ConocoPhillips, and of course Petro Frontier, who have released some very interesting results from their southern Georgina acreage already, and they're moving on to drill their second well. Obviously, we're in Australia, and I won't hammer that point home about sovereign stability, although that's probably a little bit questionable given the current government's antics, I might say, over the last year or two. Hopefully that situation will sort itself out in the not too distant future. We have done a deal with a Sydney group called Allied Resource Partners on a major 60,000 barrel per day planned UCG to GTL project, which I'll tell you a little bit more about later on in the program. We have got some runs on the board. We don't have commercial production at the moment, but we think we will have very soon with the Surprise well, as I said, which we're about to re-enter this weekend for further drilling and testing. We've drilled 5 conventional wells, got good oil shows out of 4 of those wells, a probable discovery with the 4th well, and we have delineated about a 2 TCF of gas in place at the Uramina prospect in unconventional tight gas and carbonate sands. We've completed over 3,000 line kilometres of seismic, and every kilometre we do, practically we're turning up new drilling targets. We have discovered for the first time in Central Australia a JORC exploration target of over 2 trillion tonnes of coal under both the Mining Act and the Petroleum Act. And the reason for that is we don't know where UCG is going to be fitted in the Northern Territory jurisdiction, either the Petroleum Act, which we hope they put it under, or the Mining Act, but we've got the situation covered both ways. And as I said before, we have delineated over 6 billion barrels of oil and 59 TCF in unconventional, mean, prospective recoverable resources. We see the company as being at this stage in its development, enhanced exploration drive with additional funding and partners, and monetisation of oil for early cash flow. And I have described how in the medium to long term, 3 to 8 years, we're looking at growth and monetisation of these assets following on from the exploitation of crude oil. The immediate program for the next 4 to 8 months is focused on the Surprise well in the Amadeus Basin, where we believe we have 10 million barrels of P50 oil in place. The Mount Kitty condensate and gas target, around about 2 TCF of gas, and very importantly about 100 BCF of helium at P50 in place figures. Those of you in the audience who don't know much about helium, probably most of the audience, it's not used just for party balloons. It is a commodity that is running out. There's not enough helium in the world, and both the price and the use of helium are increasing at around about 8% per year. When the 4th generation nuclear reactors using pebble bed technology and helium as a cooling medium come on stream, there's going to be a screaming need for more helium. And I think this company is very well placed to supply a lot of that helium to the world's markets. Finally, in the Paderca Basin, we have at this stage at least 2 drillable prospects, the Simpson East prospect and the Madigan 1 prospect. We haven't determined yet which one will drill, possibly Madigan, but maybe Simpson East, and these are both 100 million barrel plus oil in place prospects. If we're successful in this first program, next year we aim to list on the TSX Ventures Exchange early in the year. We have contracted with Canaccord Genuity and Cormark, 2 of Canada's leading investment banks, to jointly lead the listing, and the reasons for that are manifold. Firstly, we believe that the Toronto Stock Exchange, in terms of the resources sector, is about 5 times bigger than the Australian ASX in the resources sector. Secondly, the Canadians and North Americans know more about unconventional exploitation than any other nations in the world. So next year we want to do a minimum of 3 unconventional wells and seismic in the southern Georgina Basin with an unconventional oil focus. We want to do 3 conventional wells in the Amadeus and Paderca Basins. And with the Surprise well, if we get any reasonable results from that, we believe that probably 10% of the potential in that particular prospect will come from high perm sandstones that will flow conventionally, but about 90% of the potential in this area, in a similar fashion to the Mereenie and Palm Valley fields, will come from unconventional reservoirs, which will benefit tremendously from horizontal drilling and multi-stage fracking. Finally, one problem which afflicts most oil and gas explorationists in Australia in terms of conventional exploration and unconventional exploration is the shortage of modern state-of-the-art drilling rigs. It costs this company probably $3 to $4 million every time we mobilise and demobilise a drilling rig into Central Australia. We can buy a brand new state-of-the-art rig that's highly mobile that'll do the job better than anything else in Australia currently for about $10 to $12 million. That investment would pay for itself just in reduced mob and demob costs in probably 3 or 4 years. So that is definitely on the cards for this company, coincident with the listing on the TSX. The timing of that listing depends, of course, to some extent on the results from this current well that we are re-entering at the moment, and obviously the state of play with the markets generally. To give you an idea of where we're at, this is the Surprise well. We had very good oil shows in Johnston. There is a salt sealed prospect over here, about 150 square kilometres. We thought we'd get smart and drill a small 4-way dip closure on the western end. it appears that we drilled a little bit too close to the edge. We got into an oil and water leg. In other words, we're on the boundary zone between the oil leg and the water leg. We drilled another well down dip from that, surprise. We've got some excellent oil shows from that. Independent reservoir engineers have certified that the single 9-metre core that we've taken from that well so far should flow at between 500 to 1,000 barrels of oil a day. And then for later generations of drilling, we've got some magnificent salt dome intrusives over here. We know it's salt because it erupts at the surface to the north of Johnston West. And we've got all sorts of lovely exploration plays to drill for later generations. This is a slide of the oil-soaked core from Surprise 1. We cut 20 plugs from this core and they were independently assessed as having this rather large capability. A 9-metre core zone with the capability of flowing between 500 unpumped or 1,000 barrels of oil a day with a pump is no mean achievement in this area. In fact, it possibly represents the most significant oil discovery in Central Australia since the 1960s, when the Mereenie and Palm Valley fields were discovered. A bit of an overview of the Mount Kitty prospect over here. Very large-scale prospect, maybe 2 TCF of gas with condensate credits in it. Now, I've only got about 3 or 4 minutes left. I wanted to get through very quickly a board you can read about later, headed up by Dr. Askin, an ex-Shell exploration manager for Australasia. We are importing unconventional expertise and talent into this company because at the moment the only people that have got much really are the service companies, Halliburton and Schlumberger. We have recruited Dalton Holgren from the US, who's worked in the Williston Basin. He's worked with the Barkin Shale, the Marcellus and Haynesville Shales and the Barnett Shales as Chief Operating Officer to replace Al Thorson, who had to return to Canada due to some family problems. We've recruited Trevor Short, who's had over 20 years' experience with both big companies and small companies, and a lot of that in the Williston Basin in the Barkin Shale play. A quick location for Surprise to the far west, to give you an idea of the scale of this acreage. That area in both green and yellow representing applications and granted permits covers 70 million acres. We've got 60 million acres under the Petroleum Act. We've got 10 million acres under the Coal Act, and this is where this vast coal target tonnage is located. That's a Surprise well that we are entering this weekend. Mount Kitty, and either one of 2 prospects in the Paderca Basin over there. Total resource table, 14 billion barrels at P50 prospective recoverable oil equivalent, and the vast majority of that has been independently certified. Moving on very briefly to the coal to close this presentation. This is our ground here, mostly in granted Mining Act permits, and then in blue you can see the Petroleum Act permits. Most of those are granted as well. Interestingly enough, Rio Tinto has taken up acreage in the green here on the fringes of our acreage, and Hancock Coal, under one of their Queensland subsidiaries, has taken up acreage over here. TriStar, who were the original pioneers of coal seam gas in Queensland, have taken up acreage in this area here in the grey. And I hear rumours that other entrepreneurial companies have taken up big acreage positions in this area here. So we're not the only loonies in the bin looking for coal in the Paderca Basin. To give you an idea of the exploration target tonnage, which is a JORC category, by the way, it's not a JORC drilled resource or a JORC reserve, it's the lowest degree of certainty, but there have been over 15 wells have intersected significant coal seams in this area, 9 of which we've drilled ourselves, and around about 3,000 to 4,000 line kilometres of seismic. So we have, and the independents have, a very good idea of what's there. McElroy Bryan have looked at some of these numbers, particularly the thickness and the calibre of the coal seams, and are very impressed. In fact, it was them, I think, who got Allied Resource Partners across the line into coming into this joint venture arrangement with us for UCG to GTL. But if we put over the known coal reserves in the world, our JORC exploration target in orange there, it gives you a bit of an idea of how much coal we have. I think that's about 20 minutes, is it, gentlemen? Oh.